Ladies and gentlemen, welcome back to the channel. In this video, I'm going to be discussing 5 common mistakes in financial projections and how to avoid them. My name is Nicholas Coriano. Went to business school, went to law school, been a professional business plan writer for the last 12 years, helping private and public companies develop professional business plans, pitch decks, and run their investor relations campaigns. In this video, I'm going to explain 5 big mistakes that can hurt your financial projections when presenting to investors, stakeholders, or lenders. And we're going to get right to it. Okay. So, number one mistake that people make when developing their financial projections is overestimating their revenue. This is a very common mistake. It's tempting when you're forecasting your revenues to forecast exponential growth, but investors want to see realistic numbers immediately. They don't want to see these numbers that are like hockey stick curves where you think you're gonna, 1,000x your return in the first 3 months. So make sure when you're putting together your financial projections, especially your revenue projections, that you're realistic. Base your projections on tangible factors like market size, sales channels, historical performance, if available, or marketing budgets. For startups, focus on conservative estimates backed by strong assumptions. These strong assumptions could be, your competitor numbers or market research again, industry analysis. So looking at your competitors' financial statements is a good way to make sure that your numbers are based in reality. So that's number one. Just totally ignoring market research or any kind of data and making your revenue numbers way too high, way too fast. It takes time for things to permeate. So if you just got an investment and you think that the revenue is going to come in month one, it takes time, right? It takes time for the check to clear first, and then it takes time to implement your marketing strategy or buy your inventory. So keep that in mind. So that's the first mistake people make. The second mistake they make is ignoring certain costs. Okay. So while if you ignore costs, what ends up happening is you have inaccurate profit margins. So covering, ignoring costs such as taxes, employee benefits, marketing expenses, even taxes can be a killer in your financial projections. So put together a checklist. Use AI to check the checklist. Look at other companies and what their costs are so you can see. So I've seen countless projections that are completely ignore costs like payroll taxes or marketing expenses, right? Every dollar of cost you miss in your projections directly impacts your profitability. Okay, so use a detailed checklist to ensure that you left no cost out, and double check by asking your competitors, asking somebody else in the business, or looking at financials of other public companies or private companies that you have access to see exactly what their costs were. The third mistake that people make when developing their financial projections is lack of supporting data. Okay. So supporting data could be things like, where did you get these numbers from, right? If you say we're going to get 1 million customers, well, does the market have 1 million customers? So investors want to see where the numbers came from. If your assumptions aren't backed by any data, the investor loses confidence, right? So use industry reports, government statistics, competitor research, and surveys to validate your numbers. Think of it this way: projections without data are just guesses, right? So you don't want to guess. You want to make sure that everything is based on an assumption that was based on something real, right? So again, market research reports, public company filings from other public companies, government statistics, all of those things can help you get good data that you can base your projections off of. The fourth mistake I see clients make is ignoring cash flow. So it's easy to say, hey, look, my startup costs are this, and this is what I'm going to make every month, and this is what I'm going to spend every month. But you have to understand how the cash flows, i.e., cash flow statement, right? How the cash flows in and out of your business. Even a profitable business can fail if it has bad cash flow management, right? So use a detailed cash flow forecast as part of your financial projections to make sure that you don't run out of cash. You've probably heard the saying that cash is king. It's especially true in financial projections. Even if your business is profitable on paper, poor cash flow can put you out of business. A detailed cash flows forecast can show that the money is coming in at the right time and going out at the right time and help you plan for potential gaps. So, for example, if you're starting a business that generally makes a lot of money in the summer, let's say like a landscaping business, right? And you're starting it in January, well, unless you're doing snow removal, right? Let's say you're only doing, cutting lawns. That means your revenue is not going to come in until May, June, July, right? And you started the business in January. Well, you're probably going to have expenses in January, like I don't know, storage, right? Insurance, maybe some space to store your equipment, right? Those expenses coming out in January, February, and March with no money coming in is going to leave you with a negative cash flow balance. So that's just one example of why cash flow matters, right? If you have cash flow that's going out and none of it's coming in, or vice versa, right? It's going to skew your perception of how profitable the business actually is. So cash flow is usually done on a month by month basis. It could be done on a year by year basis. It could be done on a week by week basis. I recommend the month by month basis when you're doing your financial projections. So you at least get a good clue of, hey, how much money is coming in this month and how much money is going out. And then look at it over the course of 1 year, 2 years, up to 5 years. So you know, hey, look, if my business has seasonality and I know that money's going out a lot in one part of the year and it's only coming in a certain part of the year, that I have to save that money from the certain part of the year to make sure I can cover the other parts of the year when the money's not coming in. And the fifth mistake I want to talk about when people create their financial projections is overlooking risks and contingencies. So, no business operates in a vacuum. There's always a risk. Economic downturns, competition, competitive pressures, supply chain issues. By presenting different scenarios, you can show investors that you prepare for these unexpected risks. Have a contingency plan in place, like reducing costs or pivoting strategies to address these potential challenges. Risks that you do not state in your business plan, if an investor sees them, they're going to look at you like you're unprepared, right? And every business has risks, right? So, for example, I'm a business plan writer. When AI came out, that was a giant risk to my business, right? If I didn't plan for that, if I didn't have other revenue streams or other service lines that I could rely on, it would have crushed my business. If I was presenting to an investor today for a service-based business that, let's say, a professional writer, right? Like a business plan writer, and I don't address the concerns of AI, or another technology SaaS platform that develops business plans for you or financial projections for you, then this is going to be looked at by the investor as someone who didn't do their homework, right? So that's another mistake. That's the final mistake I'm going to talk about, is overlooking risks and contingencies in your financial projections. Make sure that you have a contingency plan that shows your preparedness for the uncertainties, okay? So how do we avoid some of these risks? Well, the easiest way to avoid some of these risks is to do detailed research and work your way back up to the projections, right? So the financial projections, great financial projections, are all based on great research. The best research possible is your past performance, right? This is not possible with startups, but if you're an established business, what you did before, prior, the last year, the year before, is super important, right? Because it's going to give you a good predictive tool to show what you're going to do in the future. Now, there's a reason why when businesses that are established do year over year comparisons. What do I mean by that? They don't compare last month to the month before. They compare last month to the month before last year. So, for example, in December, they don't compare it to November. They compare it to December last year, right? In January, they don't compare it to December. They compare it to January last year. Why? Because of seasonality, right? Money comes in and out of businesses at certain times and certain seasons, and they want to be able to compare it at the same time of the year before. So that's the best data you can use if you're an established business. If you're a startup, you want to look at other established businesses or other market research that shows what other businesses in your field have done or other startups have done. So good market research is really the bedrock of any strong financial projection. The second tip I would have for avoiding mistakes is use tools and templates that stay organized and that customize your business based on your unique needs. So, for example, a service-based business might be different than a product-based business, is different than a professional consulting business, is different than a manufacturing business. So there's tons of tools and templates out there. Google Sheets has tools, Microsoft Excel has templates. We sell templates on servitude.com. I have templates that I can give my clients, right? Use a good template and use good tools. Excel has good tools. There's a lot of financial calculators out there that have good tools. There's a lot of professional projection tools and SaaS platforms that allow you to adequately project your financial projections. If you're unsure, this is my final tip. If you're unsure, consult a professional. It's worth the investment to get it right, right? So I can definitely help. And there's a lot of other more qualified professionals out there for sure. Make sure you do your homework, that they know what they're talking about, right? You don't want to pay somebody and then they don't understand business or they've never run a business, right? There's a lot of consultants out there like that have never run a business, right? So make sure you get somebody that has a little bit of skin in the game, that has done it before. But that's my final tip. But number one, get good research. That's the best thing you can do for your financial projections. If a consultant's not going to do the research for you, the projections are going to be garbage anyway. So make sure you have good research and work back end your way into the financial projections, and then use good tools and templates. That's one of the key things that you can do. Okay. So I hope this helps you avoid mistakes in your financial projections. To recap, avoid overestimating revenue, avoid ignoring costs, skipping supporting data, neglecting cash flow, or overlooking risks. These mistakes are common, but entirely avoidable with the right approach. If you found this helpful, check out my other videos about creating cash flows and defending your financial projections. I have a ton of videos online for business planning, financial projections, startup, presenting to investors, developing your pitch deck, or check out my website. I have a ton of blogs there. I'll put the link below. And don't forget to like, comment, and subscribe for more tips. And share this video with a friend if you think it'll help them. I'll catch you guys on the next video.